Hi everyone, I am Suhas Mohan and I have joined being ACCA as a tax mentor. And in this video, we will be discussing the Section A of 2025 pre-June mock. Before you guys watch this video, I would recommend all of you attempt the mock and then come and watch it because it will help you in identifying the areas where you are going wrong and have a better improvement plans for the coming last 1 week. So in section A, we have a total of 15 questions with total of 30 marks, with each question carrying 2 marks. So with the thumb rule of ACCA of, of spending a time of 1.8 minutes per mark, we can spend a total of 3.6 minutes per question and in total 54 minutes for the section A part. So if you spend more time on one or two questions due to the calculations, try to cover it up and ensure that you finish your entire section A within the 54 minutes time slot. So let's start off with the first question. Brownie Limited owns 95% of the ordinary share capital of Cookie Limited and 100% of the ordinary share capital of Bicky Limited. Cookie Limited owns 75% of the ordinary share capital of Donut Limited and Bicky Limited owns 58% of the ordinary share capital of Wafer Limited. Which companies are within the Brownie Limited's chargeable gains group? So, what is the rule for being a part of the chargeable gains group? That at every level of the ownership, the company should own at least 75% of that company, and the ultimate parent should have an effective interest of 50% on on the subsidiary companies. So if we can start looking over here, Brownie, since Brownie owns 95% of Cookie and Bicky, 100% of Bicky Limited, they both will automatically be part of the chargeable gains group. And now, since Cookie owns 75% of the ordinary share capital of Donut Limited, we should identify how much does Brownie Limited own. So that can be calculated by 0.95 into 0.75. That gives us 71%. Since it is more than 50%, even Donut Limited will be part of the chargeable gains group. But now, if we come to the next one, BK Limited owns 58% of the ordinary share capital of Wafer Limited. We see that it doesn't meet the requirements of the chargeable gains group because BK Limited itself is not owning more than 75% or more in the Wafer Limited. So this will not be part of the so Wafer Limited will not be part of the chargeable gains group. So the correct answer would be BK Limited, Cookie Limited, and Donut Limited. Going to the next question. Drake started a new sole trade business. He then received a notice from HMRC to submit his self assessment tax return for the first year, not submit the return by the due date, and still has not submitted it. So here the point that we'll have to identify is he did not make any returns by the due date and has not submitted anything. Indicate by clicking on the relevant boxes in the table below. Which of the following actions can HMRC take in order to collect any tax owing in respect of Drake's unfiled return? So since the return has not been filed, we'll have to identify what is true and what is false. Start a compliance check inquiry into the return. So the statement itself is false because a compliance check can only be started if a return has been filed. Since there is no return been filed, this cannot be an applicable factor that HMRC can take, so it will be false. Make a determination. Yes, HMRC can make a determination if we fail to file our returns by the due date or post that. Offer an internal review and raise a discovery assessment. Again, both these elements can only be done if a return has been filed, but since that is not the case here, both the statements are false. Next question is, Thomas has been running his sole trade business for many years. He had an income tax and class 4 NIC liability for the tax year 23-24 of 23,400. Thomas believed that his trade would experience a slump in a tax year 24-25, so made a claim to reduce his second payment on account for 24-25 to 10,000. He made this reduced payment on 31st July 2025. So when a payment of the account is being made, payment on account is being made, it is based on the income tax and class 4 NIC liability of the previous year, of the previous tax year, that is 2023-24. And payment on account is made in two installments, is made in two parts, with first being made on 31st January 2025 for the tax year of 24-25, and the next on 31st July 2025. 2025. If there's any income that is still pending, then that amount will be any income tax liability that is still pending of their income tax liability that actually arises in 24-25, then that will be paid in 31st Jan 2026. Now, if we say how much interest will Thomas owe HMRC in connection with the second payment, so Thomas will owe any interest only if the amount that he has paid, if he has paid less amount than the amount that is actually expected to be paid. If we can see here, the payment on account will be is equal to half the income tax liability of 23,400, which will be is equal to 11,700. And if we see the liability here, the 24-25, the liability is 14,300. So he has already made the payment on 31st Jan. And now in July, he is planning to make a payment of 10,000. So in total, he has made a payment of 21,700. But the tax liability for the year 24-25 was only 14,300, which is less than the total amount that he had paid. So because of that, he is actually not making any late payments. And because of that, so there will be no interest that is accruing on this. So how much interest will Thomas owe HMRC? The answer would be zero. So guys, in tax exam, getting an answer of zero is very much possible, and you should never eliminate the possibility of that happening. And because the questions like these are usually used to test you guys if you have understood the concepts or not. If you have understood the concept, stick to those concepts and do not get confused during the exam that can the answer be zero? Am I doing it wrong? No, you are not. If you're thorough with your concepts, the answer that you get will absolutely be right. Moving on to the next question. McGill Motors Limited has made the following purchases and disposals of shares in Princeton Pylons PLC over the years. It has purchased on June 2nd, on 1st June 2002 of 40,000 shares for 55,000. And then it has disposed them on 17th September 2024 for 97,000 for 12,000 shares. And we have the indexation factor has also been provided to us. What is the index cost that should be deducted in calculating the chargeable gain on the sale of shares on 17 December 2024? So, so the question that is being asked is what is the cost of these 12,000 shares, index cost of these 12,000 shares? Since there were no matching rules that had to be applied, since there was only the share pool only consists of the shares that were purchased in 40,000, the index cost of these 40,000 shares will only be prorated to these 12,000 shares that are being sold. So for that, if we have our scratchpad open, so in the test, if you're writing a center-based exam, you will be provided with you will be provided with a rough sheet that can be used for making your calculations. But in your home exam, that is not possible as per my best knowledge that I have. So try to use a scratchpad if you're writing it in home-based examination. So now let's see his the purchase was 55,000. So the indexation allowance would be 55,000 into 0.578. That would be 31,790. 31,790. So the total cost, index cost would now be 86,790. Now this 86,790 is to be allocated for the 12,000 shares. So that is 86,790 into 12,000 divided by the total number of shares, that is 40,000 shares. That will give us our index cost for the 12,000 shares at 26,037. This is the answer. Now let's go to the next question. Brandel sold an antique vase in October 2024 for the net proceeds of 7,800 after deducting selling costs of 1,700. She had originally purchased the vase in June 2015 for 5,350. So here, if we can see, the highlighted points that we have to remember are: it is an antique vase, the proceeds were 7,800, the net proceeds were 7,800, and the cost was 5,350. So if you highlight these points, next you can go read the question that says, what is the brandy's capital gain arising on the sale of antique waste? So according to the capital gains rules, we have studied what are wasting chattels and what are non-wasting chattels. So in this case, it has been provided that it is an antique waste. So antique waste is a non-wasting chattel because it has a life of more than 50 years and also it is a movable asset. So that is the reason why it is a non-wasting chattel. So if we are applying the taxable chargeable gain rules for non-wasting chattels, which have a cost of less than 6,000 and the proceeds net proceeds of more than 6,000, we'll have to restrict the chargeable gains to lower of 5 by 3 into the gross proceeds minus 6,000, or the normal calculation that we do, that is net proceeds minus cost. Now, if we do the calculation here, we get is equal to 5 by 3 into gross proceeds. Gross proceeds would be 7,800 plus 1,900 plus 1,700, sorry, minus 6,000, or the calculation here would be simple 7,800 minus 5,350. If we have a calculator on, we can see that 1,800 plus 1,700 minus 6,000 would give us total 3,500. 3,500 into 5 by 3. 5 by 3. So that will bring our answer to 5,833, equal to 5,833. And here the net proceeds would be equal to this. The normal calculation would be is equal to 7,800 minus 5,350. That gives us 2,450. So we have a clear answer, which since it is lower of either of these, we should consider 2,450. That is the normal calculation that we apply. Let's go to the next question. Garrett made a VAT inclusive standard rated supply on 1st December 2024 for a consideration of 2,850. Select the correct values for this supply. The value VAT element is and the value of supply is. So if we can see that this is a pretty straightforward calculation that we'll have to perform. So since it has been provided as a VAT inclusive supply, so the cost is a VAT inclusive one. So it is, then the VAT element would be calculated as 2,850. 850 divided by 6. That will give us 475. And when they ask for the value of supply is nothing but the VAT exclusive price or the consideration that would be received for the VAT exclusive consideration. So in simple, it can be calculated as 2,850 minus 475. 850 minus 475. That is 2,375. Here we go. This is the answer for this. Now let's go to the next question. Which of the following statements about tax returns is incorrect? So usually when we are going through the theoretical questions, it's always better to look at all the 4 options, then make a decision. on choosing the right answer. So what is the first question that we've got? The tax return comprises a main return form together with supplementary pages for particular sources of income. Okay. Then we have a partnership must file a separate return and account for each partner's tax on this return. Okay. And the third point, if HMRC calculates the tax for the taxpayer, it merely does so based on information provided and does not judge the accuracy of it. The fourth statement being an employee who only has employment income with the tax collected under the payee, it is not required to complete a tax return. So let's start after identifying all the points. If you're still unable to identify the correct answer, then the way to go about with that is the elimination method. So let's start with eliminating the wrong options. A tax return comprises a main return form together with the supplementary pages for a particular source of income. This is a pretty straightforward, straight answer. If you look at the tax return, the requirements of a tax return form, you or what all consists of a tax return form, you will be able to answer this. So this is clearly a wrong answer. Next, if we go to this, if HMRC calculates the tax for the taxpayer, it merely does so based on information provided and does not judge the accuracy of it. Yes, again the same correct answer. This is also correct answer. Now, coming to the fourth, an employee who has only employment income with the tax collected under payee is not required to complete a tax return. Yes, because if an employee is only having an employment income, then that entire tax liability would be deducted under the payee system. So there's no requirement to have a self-assessment or a tax return being made over here as well. So this is also the right answer, wrong answer. I mean, this is also right. So this is not what is the requirement as it's asking for an incorrect option. Now, coming to the second option, a partnership must file a separate return. Yes, must file a separate return and account for each partner's tax on this return. But if we can see that the tax return for the partnership must be filed showing the profits of the entire partnership and how these profits are split between both the partners. But there is no necessity for the partnership to file any tax returns, and because the partners will individually pay their taxes. So here, this is clearly a wrong option. So that is the statement that we will be selecting. You can either, if you're very thorough with the theory, then you can directly select the correct answer. And if you are feeling a bit confused, try to use the elimination technique because that will help you in clearing the doubt. Next, for the year ended 31st March 2025, Early Time Limited has a taxable total profits of 220,000. The company has also received dividends of 13,000 from non-associated companies during the year. What is Early Time Limited's corporation tax liability for the year ended 31st March 2025? So, as we must have studied in corporation tax, dividend income is exempt. Dividend income from any companies is exempted. So, corporation tax would only be payable on the taxable total profits. Taxable total profits of 220,000. Now, in this situation, if we go to the tax tables are something that is very useful, guys. So if you look at the tax tables for corporation tax, you can identify that for small profits the rate is 19% and for the main rate it is 25%, and we have lower limit and upper limit. These lower limit and upper limit are relating to the taxable total profits. So if we can see, our taxable total profit falls between 250,000, 50,000 and 250,000. So because of that we will be receiving a marginal relief. So these three are a very important points that are provided, and based on these you will be able to calculate. So first, we will be getting marginal relief on the augmented profits. If you can see this, augmented profits is nothing but your taxable total profits plus dividends received from non-associated companies. So first, let's open our calculator and scratchpad. Always remember these three important. First, let's calculate what our augmented profits are. Augmented profits are 220,000 plus 13,000 That brings up our total to 233,000. Now let's go on, since we have got our augmented profits, now let's try to identify what is the what is the taxable what is the corporation tax at. First, we'll calculate the corporation tax on 220,000 at 25% normally percent. That will be equal to 25%. We get we get 55,000 as a corporation tax. But from this, we will have to deduct from this less the marginal relief that we receive. What is the marginal relief that we receive? Marginal relief is equal to upper limit. Since there are no any associated companies, the upper limit would not be adjusted and it would be total of 250,000 only. So our marginal relief would be 250,000 minus our augmented profits, that is 233,000, into the standard fraction. If we can see, the standard fraction is 3 by 200 into 3 by 200 into taxable total profits. What are our taxable total profits? 220,000. So 220,000 divided by augmented profits of 233,000. So here if we calculate, first let's do the calculation part properly. 250,000 minus 233,000. We get total 17,000 is equal to 17,000 into 3 by 200 into, we have taxable total profits of 220,000 divided by 233,000. We get 0.944. Okay, we can round it to 0.94. So now calculate 3 by 200 into 0.94 into our 17,000 that we have calculated. And then we get a relief of 239.7. So if it is 239.7, you can round it up to 240. So marginal relief would be 240. We deduct this from our corporation tax of 55,000. That is 55,000 minus 240. We get 54,760. That would be our answer, 54,760. And that is how we calculate when we are having a profitability, when we are having a taxable total profits between the upper limit and lower limit. If it is more than upper limit, it is straightforward 25%. If it is less than 50,000 limit, then we have it at 19%. Okay, we're going on to the next question. Hansel and Gretel arrived in the United Kingdom during the tax year 2024-25. Neither had previously been a resident in the UK, and neither of them worked in UK during the tax year 24-25. In July 2024, they each acquired separate homes in the UK. Neither of them has any other home. The tax year 24-25, Gretel had spent 39 days in the UK and Hansel spent 66 days in the UK. Which of them is or are resident in the UK for the tax year 24-25? So first, in order to identify who are residents, first test that we will be performing is the overseas test. So whenever they satisfy the overseas test, they're automatically not the residents. So let's see, first let's see for Hansel and then let's go to Gretel. So Gretel has spent 66 days in the UK. So what are the automatic overseas tests are? Spending less than 16 days, pending less than 16 days in UK. Next, since she has spent more than 16 days, she has spent a total of 66 days. So she's automatically not satisfying this test. Then the next is less than 46 days and less than 46 days. Even this is eliminated based on this only because she's spending 66 days. And the next is less than 91 days, 91 days and working full-time overseas. But if we can see, neither of them have worked in the UK during the tax year, so this also will be eliminated. And next, coming to our UK test. UK test, we can see that she's having a house in UK, so that will clearly satisfy the residency test. And then Hansel will be considered a resident. Now coming to the next point. Now coming to Gretel. So Gretel has spent less than 16 days. No, this is not being satisfied because she has spent 39 days, not satisfied. The next is less than 46 days. But if we consider this, since she has spent less than 46 days, what is the other thing that has to be satisfied? That is not be a tax resident in the previous 3 years. If we can clearly see, neither of them had previously been the resident in UK. So here she's satisfying both the conditions, that is less than 46 days and not a tax resident in the previous 3 years. So this clearly shows that she is not a tax resident of UK, not a UK tax resident. So because of that, the answer would be which of them is or are resident in the UK. The correct answer would be Hansel only. Always remember, guys, first the automatic overseas tests are to be satisfied, then the automatic UK test, then any ties, then if we are unable to clarify from both of them, then the ties will come into the picture. Okay, moving on to the next question. DFB decided to change its accounting date and so had a 15-month period for the period ended 31st March 2025. By which dates must DFB file its corporation tax self-assessment tax returns for the 15-month period ended 31st March 2025? So when we have a 15-month period, it will usually be the tax returns should be filed for accounting period and the due date is determined based on the period of account. So here, if it says accounting date and so had a 15-month period, this 15-month period is a period of account. 15-month period is a period of account. And in this, we'll have to determine what all are the, and now the accounting period of account, and it starts from 1st of January 2024 to and runs all the way till 31st December 31st, sorry, my bad, 31st March 2025. Now now we'll have to determine what the accounting periods are. Accounting periods are 12-month period and the remaining period, 12-month, and next would be the remaining period. Next would be the remaining period. We can see 12-month, the first 12-month period would be ending on 31st December 2024, and the period, other period of account, other accounting period would be ending on 31st March 2025. So here, if we can clearly identify that 15-month period, they will have two returns that are to be filed. Two returns that are necessary. One is for the period ending 31st December, and the next is for 31st March 2025. But when we are actually making a self-assessment, it will only be made for what 12 months from the end of period of account. So that would be, so if it is 31st March ending on 31st March 2025, then we would have it on 31st March 2026. Now let's look at our options to identify what is the right. The return for the 31st year ended 31st December must be filed by October, and the return for the period of is this is clearly eliminated because in October we will not be making, because our return would be filed for the period of account. One return, again, this can clearly be eliminated from the first two returns because it is not for one return, it should not be one return, but it should be two relating to two returns that are to be filed. That is, so 31st December ending and 31st March ending. Then the 31st return for 31st March must be filed by December 2025, and the return for the period ended 30. See, again over here, it should be filing should only be based on period of account. So it will also be eliminated. So here now we come to the next one. The returns for the year ended 31st December 24 and the period ended 31st 25 must both be filed by 31st March 2026. So this would be an appropriate answer that we will be selecting. Clear, guys? Yes. Now let's come to the question that has inheritance tax. Linus died on 5th November 2024, having made a lifetime cash gift of 600,000 to a trust on 16th October 2023. Linus paid the inheritance tax arising from this gift. Now we will have to select the correct options. The correct options would be, what should be the correct options for who will be responsible for paying the additional IHT arising from the gift made to the trust as a result of Linus's death. And next would be the additional tax that would be paid. Okay, it's not the amount that is to be paid, it is the additional tax will be due date. What is the due date for the additional tax? So now let's see what all are the options we have got. So since the gift has been paid, since the gift has been made into a trust, it is a chargeable lifetime transfer. Chargeable lifetime transfer. So on death of an any individual, the chargeable lifetime transfer, the any gift, any payment, remaining payment that is to be made will be paid by the trustees. So here we have it. It will not be paid by the personal representatives because it will not be a part of the death estate. And the additional tax will be due on. So always remember the due date for the additional tax would be from the end of the month of the Linus's death and 6 months from there. So it will be from 30th November, 6 months from 30th November. That would be 31st May. Here we have only option of end of the month, 6 months from there. So this is the appropriate option. So usually if options like these are given, you need not have to identify 6 months because it from the end of the month there are only one that is ending on 30th or 31st. So that would be our appropriate answer. Okay, coming to the next question. Mouse House Limited is a UK company that is incorporated on 1st December 2024. The company started to trade on 1st February 2025 and made up its first accounts for the period to 31st August 2025. By which date must Mouse House Limited notify HMRC of its first accounting period? So this is again a theoretical question and you will have to remember this. So the blind answer for this would be starting 3 months from the start of trade is when you will have to notify HMRC. So 3 months from the start of trade would not be from 1st of December, but would be from 1st December 2025. So 3 months from 1/2/25 would be 1/5/25. That is 1st May 2025. So usually if you are spending a lot of time on calculations part, try to cover it up in these theoretical questions because you just have to remember the theory concept and you can speed across through the section A and section B's. Next, Blair has lived in a job related accommodation provided by her employer for many years. She was provided with this accommodation for her own personal security due to the nature of the job. Blair has an annual gross salary of 50,000 for the tax year 24-25. Her employer always pays for heating, cleaning and lighting for the accommodation as well, which has a total annual cost of 7,000. Her employer also provided Blair with furniture on 6 April 24 at a cost to the employer of 10,000. What is the total amount accessible to income tax for Blair in the tax year 24-25 in relation to the furniture, heating, cleaning, and lighting costs? So clearly, it can be identified. First, we'll have to identify if it is a job-related accommodation, mandatory job-related accommodation. Is it? It is a job. It has been identified as a job-related accommodation, and it says that the accommodation is for her own personal security due to the nature of the job. So clearly, it can be identified that this job related accommodation would not have any would not create any taxable benefit, and it is an exempt benefit because it's being provided for her own security. So if that is the case, then any additional costs that have been incurred, the total benefit arising out of those would only be equivalent to 10% of her annual salary. So here the clear answer would be, we have identified that the gross salary of 50,000. So the total amount accessible in relation to these costs would be restricted. The total cost though might be 10,000 plus 7,000 of 17,000, but it will only be restricted to 10% of her gross salary, that is of 50,000. So 10% of this of 50,000 would be 5,000. So 5,000 is our answer. So if you identify points like anything that is exempted benefits, but you if there are any other conditions assist to that, try to remember and make a memory of all these exempted benefits, because if you're able to remember the exempt benefits, then you'll be able to identify the non-exempt ones. Moving to the next question. Farina commenced her sole trade business on 1st June 2024 and registered for value added tax on 1st October 2024. The first VAT return for her business is for the quarter of 31st December 2024. During the period 1st June 24 to 31st October 2024, the business incurred input VAT of 110 per month in respect of the hire of office equipment. Okay. How much input VAT in respect of the office equipment can Farina reclaim on the business VAT for the business VAT return for the quarter ended 31st December 2024? So here, since she has registered for VAT, registration for VAT took place on 1st October 24 for quarter ending 31st December 2024. So since she has registered for this and this is a business expense because it is relating to the hire of office equipment, this VAT can be reclaimed. So how much VAT can be reclaimed for 3 months? It is 3 months of 110 into 3, that will give us a 330 pounds. Now moving to the next part of it, can she reclaim it for the pre-trade before she has registered for VAT? Yes, because she has registered because it is relating to the office equipment and for the purpose of business. So she will be able to reclaim it prior to 6 months prior to the registration of VAT. But here, since it is from 1st June 2024 to 1st October, that becomes 4 months. It is less than 6 months. So she will be able to reclaim entire VAT for these 4 months as well. So 4 into 110 would give us 440. So now the total VAT that she can reclaim is 330 and plus 440, that will be 770. Here it is not, it will definitely not be zero because the It is considered as a business expense because the office equipment is for the business process purpose. So input VAT can be reclaimed on that. And 330, it is not taking the pre-trade into consideration, pre-VAT registration into consideration. 660 is obviously a wrong answer because it's considering only 3 months, but where we have 4 months here. Okay. So now let's move on to our last question. BS Boomers Limited commenced trading on 1st Jan 2023. It has always had one associated company. The company's augmented profits have been as follows. Year ended 31st December 2023 were 452,000. Year ended 31st December 2024 was 933,000. And the year ended 31st December was 2025 was 1.012 million. What is the first year for which BAS Boomers Limited will be required to pay its corporation tax liability by quarterly installments? So, in order to pay quarterly installments, the augmented profits should be over 1.5 million. But since it has an associated company, the augmented profit threshold would be reduced from 1.5 million to 2 divide, divided by 2 would be 750,000 because it has one associated company and itself. Total would be two companies. So it will be divided by 2, giving us 750,000. So now we should identify in the periods where where the augmented profits are exceeding 750,000. We can see that it is being exceeded in 31st December 2024 and year ended 31st December 2025. So the other condition which we'll have to identify when it has to pay in quarterly installments is that if it was previous year also it was exceeding the threshold previous year, also it was expected to pay in quarterly installments, or if the total profits is exceeding 10 million. In 2024 we can see in the previous year there was no requirement for it to pay it in quarterly installments because it was not exceeding the augmented profit threshold. So in 2024, it is not necessary for it to pay in installment purposes. But here in 2025, we can see that the prior year is exceeding the augmented profit threshold of 750,000. So because of that condition in 2025 and even in 2025, it is exceeding the augmented profit threshold. So the year 2025, a year ended 31st December 2025 would be when Base Boomers Limited would be expected to pay its corporation tax liability in quarterly installments. So with this, we come to an end of our section A. Now, check out the following videos for section B and section C. Bye guys, have a good day.